Hello friends, in this video we will discuss how finance can be calculated. Finance is a critical aspect of modern economics and is central to the efficient allocation of resources. Finance involves the management of money, assets, liabilities and investment, and it is essential for individual, business and government to have a solid understanding of finance to make informed decisions. Finance can be broken down into several subfields, including corporate finance, investment management, financial planning, and risk management. The goal of this essay is to provide a comprehensive overview of finance, how it is calculated, and its importance to individual business and government. Number one, understanding finance. Finance is a broad field that encompasses the management of money, assets, liabilities, and investment. It is concerned with how individual business and government can make the most of their financial resources. Finance is critical to economic growth and development as it allows resources to be allocated efficiently and help to promote investment and innovation. There are several different subfields of finance, each of which is concerned with a specific aspect of financial management. Corporate finance, for example, is concerned with the management of company finance, including its capital structure, investment decision, and financial option. Investment management, on the other hand, involves the management of investment, including stocks, bonds, and real estate. Financial planning is concerned with helping individuals and families plan for their financial future while its risk. Management is concerned with managing financial risk. Part 2, calculating finance. Calculating finance involves the use of various finance formula equation to determine the value of financial assets, liabilities, and investment. These calculations can be complex and involve a range of different factors, including interest rate, cash flow, and risk. One of the most fundamental calculations in the finance is the time value of money. The concept is based on the idea that money today is worth more than money in the future because it can be invested and earn a return. The time value of money is calculated using a formula that takes into account the present value of money, the interest rate, and the time period over which the money will be invested. Another important financial calculation is the calculation of net present value. Net present value is used to determine the value of investment by calculating the present value of the expected cash flow from the investment and thus subtracting the initial cost of the investment. If the net profit value is positive, the investment is considered to be profitable. Other financial calculations include the calculation of the cost of capital, which is the cost of financing a company operation through a combination of equity and debt. The cost of capital is calculated by taking the weighted average of the cost of equity and the cost of debt. Importance of finance. Finance is essential to the success of individual business and government. For individual, finance is important because it allows them to manage their money effectively and the plan of their financial future. This includes saving for retirement, purchasing a home, and investing in their children's education. For businesses, finance is critical to their success because it allows them to make informed decisions about investment, financing, and capital structure. Businesses need to have a solid understanding of finance to be able to grow and compete effectively in the global marketplace. Governments also rely on finance to manage their budget and finance public projects. This includes investment in infrastructure, in education and healthcare. Without effective financial management, government can struggle to balance their budget and provide essential public service. Conclusion. In this conclusion, finance is critical aspect of modern economics and its importance cannot be overstated. Finance involves the management of money, assets, liability, and investment, and it is essential for individual, business, and governments to have a solid understanding of finance to make informed decisions. Calculating finance involves the use of various financial formulas and equations to determine the value of financial assets, liabilities, income statement. The income statement, also known as the profit and loss statement, reports a company revenue and expenses over a period of time, usually a quarter or a year. It provides an overview of the company profitably and help investors understand the sources of revenue and the expenses incurred incurred to generate that revenue. The income statement is divided into three sections: revenue, expenses, and net income. Revenue include all income generated by the company, such as sales, fees, and interest. Expenses include all the costs incurred by the company, such as salary, rent, and utilities. Net income is the difference between revenue and expenses and represents the company profit or loss for the period. Balance sheet. Balance sheet provides a snapshot of the company financial position at a specific point in time. It shows the company assets, liabilities, and equity. Assets are resources owned by the company, such as cash, account receivable, and inventory. Liabilities are the company obligation to pay debt, such as account payable, loans, and taxes.